Good morning, everybody. It's a pleasure to be here in this amazing city. We are in the Commission in ECFIN, Economic Finance Affairs. We are doing forecasts 4 times a year, so independent technical forecasts. I would say we're in the middle of the process of producing our spring forecast for 15th of May. So I cannot give you exact numbers, but I can give you, the overall travel that we're doing. Let's start with the key messages, so those you can take home in your presentation will be important. The first important thing is the global economy has turned the curve. The IMF, for this reason, the World Economic Outlook labeled it steady but slow. The EU economy is bound to resume growth after a very weak and lackluster 2023. Inflation is returning to target, coming back to that at the moment. The EU economy has shown remarkable resilience in the face of unprecedented shocks, and I will run you through a couple of slides in a moment to also look at these more structural features that the Commissioner actually already referred to. And if there is time, I'm also happy to give a bit of an outlook on the fiscal new rules that are actually coming into force today in order to balance EU's growth and sustainability challenges. So the idea is to run you through a couple of slides identifying the key drivers for our growth outlook, and then zoom in on a few illustrations of the structural features, and then let's see how we're going in time to look at some of the more big-ticket items. Let's just for time management. What's important to recall is with the global economy is going through a pretty much unprecedented synchronized cycle of disinflation after the explosion of inflation, energy price-driven inflation of the global economy started in 2022. The euro area is no exception. It moved to an unprecedented, swift, drastic increase of monetary tightening in order to get inflation under control quickly, and importantly also to maintain inflation expectations anchored. Importantly, the Commissioner mentioned already the impact of the war on the European economy. Energy prices and particular availability of gas have been the most important impediments to the economic performance in Europe in 2023. There has been a lot of anxiety about the availability and the possibility to decouple from fossil fuel imports from Russia. Now, looking ahead, and that's important, we're now in a much safer place. At the same time, energy prices overall remain somewhat higher than they were before the crisis. Just a quick word on the global world trade. We have seen last year a particularly slump of world trade dynamics. We're expecting going forward that this should normalize. In terms of global growth, I'm not going to spend much time here in the US and China, and move quickly. Maybe just one word. So in terms of the external environment, we are very much on the same page as the IMF. So we see that the global economy has gained traction, but there is also not much of an impulse. So a bit of an impulse we expect coming from the normalization of trade intensity of global growth. That should help Europe, but it's not the main factor for the European economy. The forward-looking survey indicators that we're looking at each beginning of the forecast are basically giving us pretty much a mixed signal. What's important to look at the dynamics of this, and what we have seen, the blue lines here are the PMI, the yellow lines are European segment indicators, is that we have basically a bottoming out signaling not a spectacular recovery, but basically the conditions for a solid rebound of growth going forward. Inflation is coming down very nicely, and as you can see, you've seen the gray parts of that mountains is the energy price dimension of the inflation development. We have seen a high energy price driven inflation development, and since autumn last year, energy price developments are actually subtracting very forcefully from the inflation developments. And as I already mentioned, on the right side, you see one of the measures for expectations on inflation, and that's quite remarkable that throughout this relatively protracted high inflation period, inflation expectations in Europe and the years before Euro area in particular remain fairly well anchored. So that's a signal of trust in the institution, but also the ability to manage the situation. The most important element, and this is, I should stress, the key driver of our economic recovery that we're foreseeing for this year and next year, is watched with the unprecedentedly strong labor market in Europe. It's difficult to put the finger on it, but it's probably also partly due to many reforms undertaken in Euro area member states over the past 15 years. And it's quite remarkable also in the context where last year we've seen very disappointing growth performance in Europe, but still labor markets remain very strong. And there was some softening. So you see the vacancy rate, which by the way is also at historically high levels, is coming down a little bit. That is actually quite remarkable. Now, this is important because since October last year, we're seeing a recovery of real income and real wages. And the strong labor market is magnifying this effect of the rebound in real wages and real income. So our main driver for the economic recovery going forward is basically the combination of this real wages and strong labor markets. Now, in terms of numbers, as I said, these are the numbers depicted from our winter interim forecast, and the new numbers will be out by the 15th of May. We have, in terms of GDP for 2024 for the Euro area, 0.8 in our winter interim forecast and 1.5 for next year. I'm not giving away a secret that our numbers for this spring will be pretty much in the same ballpark. Not so much different. We had technically speaking a bit of a negative spillover from the weak developments last year. On the other hand, yesterday's figures of GDP for a number of EU member states surprised on the upside, which is very welcome. So we may not be so different. Inflation, at the same time, we're pretty confident that we will take down our numbers. I mean, right now we have for the year 2.7 for the Euro area and 2.2 for 2025. We're most likely see inflation dropping a little bit faster than what we have here. The good thing also is that the growth and the recovery in Europe is spread out across all the EU member states, including looking forward to 2025, a somewhat faster growth in the Eastern European member states, which were more heavily hit by the energy price explosion because of their relatively still energy-intensive production composition of their economies. Now, let's take a quick look beyond the more cyclical developments into some of the structural features. I promised, and here, bear with me, I'm jumping a little bit through slides. I actually want to spend a moment on this one. When COVID crisis struck, and the discussions about the response were taking place, as Commissioner Hahn was referring to. One of the important lessons were what happened during the big financial crisis in Europe, where capital market fragmentation caused huge damage to economic growth in Europe. And you see that on the left-hand slide, just depicted here with the risk premia and basically the yields in the euro area, how they diverged very strongly in 2012-13. And that obviously reflected also differences in confidence in member states. Not good for Europe. Now on the right-hand slide chart, you see the situation when the COVID shock struck. We had initially a similar market reaction, but then the very decisive and unprecedented decisions about the launch of a recovery and resilience facility with new generation EU budget and its financing, the nature of its financing came, and that really sent a very important signal to the countries, to the markets, and had an immediate stabilization effect. Now I have to translate perhaps some of the abbreviations here on the slide. NGEU is for the new generation EU budget. PEP is the abbreviation for the special monetary policy instrument that the ECB put in place. And what's important here to stress also that it was a very fast and very good coordination of policy across the EU, but also member states. And I'm happy to come back to that also with the question and answers. Now, when we take a look at the growth performance in relation to these policy experiences, you see on the left-hand chart with relative recovery after the global financial crisis struck. And Europe was basically left in a protracted, slow growth moment for quite some time. One factor of this was also that the cutting of public investment was one of the first victims of the primary consolidation strategy for many member states, with negative implications also to how they go, potential growth going forward. Now the blue line shows the recovery and the speed of recovery in response to the COVID-19 crisis. And the right-hand slide, the chart, just shows quickly the how public investment was maintained during that period. Now, just a couple of further elements here. What I would like to stress with a look at the left-hand slide, that gives you these columns the dependency of the EU economy on Russian gas. And in 2022, there were huge questions about how the economic impact of the decoupling could actually play out and how difficult that would be. This slide for me is a story about the incredible capacity of the private sector to adapt. So corporates who were using Russian gas found different ways of reducing, increasing efficiency. There was collective effort done at the EU level to help diversify sourcing of gas, and there was a lot of saving going on. And the right-hand chart is just to illustrate that we're now in a relatively comfortable situation also when it comes to storages. Now, I'm pretty much up in time, so I'm very quickly just 2 slides, super colorful on the right-hand side. The main message here is that's also a remarkable feature that during all this crisis, the euro exchange rate remained fairly stable and unaffected. And here I'm ending basically with this on the left-hand side. This depicts the current account developments of countries with a huge current account surplus and deficits in the euro area, which was a big concern of instability during the great financial crisis. So here we're also seeing a gradual convergence of those risks. And the last slide, little chart that I wanted to spend a moment on is obviously EU member states came out of the COVID crisis with a higher level of public debt. At the same time, the inflation surprise and the high nominal growth that we've seen in 2022 in particular has also helped to bring the debt ratios down. As I said, today we have a new set of fiscal rules. Just 2 words on those. They are more realistic in the sense that they are more country specific. They give more time for the adjustment, and they're balancing investment and reform needs in member states with the fiscal consolidation imperative for a number of countries. They have been negotiating with member states in the sense of creating and maintaining ownership and agreement on these rules. So we're quite confident that this is a good start for also tackling this happening. With that, I stop here.